April 10th, 1912, RMS Titanic's departure date. One of the world's richest men, JP Morgan, cancelled the trip at the last minute. Official explanation, business meeting. Real reason, Morgan's astrologer had warned him. Morgan once said, "Millionaires don't use astrology. Billionaires do." October 19th, 1987. Monday morning, when the New York Stock Exchange opened, the world experienced the largest one-day crash in history, Black Monday. The Dow Jones fell 22.6%. $500 billion evaporated in a single day. What was happening in the sky that day? Saturn and Uranus were in exact opposition. Pluto, Venus, and Mercury were locked together in Scorpio. Coincidence? This story oscillates between two worlds. First world, Bloomberg terminals, high-frequency trading algorithms, millions of data points. Second world, ancient star charts, planetary cycles, the geometry of time. Which is real, both, or neither? Welcome. I'm with the Data Astroarchaeology channel, and today we're investigating Wall Street's most forbidden secret. Who are the prophets of Wall Street? Algorithms or planets? 3000 BC, when Sumerian priests studied the sky, they weren't just looking for messages from the gods. They had discovered something. Time is cyclical. Venus completes 5 full cycles in 8 years. Jupiter completes the zodiac in 12 years. And these cycles affect everything from grain harvest to trade routes. Babylonian mathematicians developed the base 60 number system using planetary movements. The concepts of minutes and seconds we still use today come from them. Why 60? Because the Saturn-Jupiter cycle lasts approximately 60 years. It's written in the Enuma Anu Enlil tablets. When there is a lunar eclipse, markets stop. When Mercury retrogrades, disputes arise in trade. Written 4,000 years ago, still accurate today. 12,000 years ago, in Anatolia, before humanity discovered agriculture, someone built Göbekli Tepe. Why? An astronomical calendar. The T-shaped pillars are aligned with specific stars, especially Sirius and Orion. According to Klaus Schmidt's research, this structure is actually a cosmic clock. Because for hunter-gatherers, the key to survival is timing. Which animal herds migrate when? Which plants bear fruit in which season? To know these, you must read the sky. What's interesting? Today's modern hedge funds do the same thing. Algorithms use seasonal cycles, lunar cycles, even sunspot activity as data. 12,000 years later, the problem is still the same. How do you get the timing right? Throughout history, every major financial center was also an astronomy center. In Babylon, priests did both banking and astrology. In Florence, the founder of the Medici Bank, Cosimo de' Medici, built a private observatory in his palace. He was one of the first quant traders to use astronomy and astrology together. When the Amsterdam Stock Exchange was founded in the 16th century, astrologers were among the first investment advisors. Even during the tulip mania, some merchants traded based on planetary positions. Why? Because for that era, this was the most advanced prediction model. Trigonometry, geometry, cyclical analysis. All came from astrology. Then came the Enlightenment. Science and irrationality separated, or so we thought. Born in Texas in 1878, William Delbert Gann was an ordinary cotton broker until age 25. Then he discovered something, or claimed to have discovered it. From an extensive study of the past, I discovered the law of vibration. This law gives me the ability to accurately determine the exact points at which stocks and commodities will rise or fall within a given time. In 1909, Ticker and Investment Digest magazine decided to test Gann. Over 25 trading days, he made 286 trades. 264 were profitable. 92.6% success rate. How did he do it? He used 3 things: geometry, astronomy, and astrology. He developed a system called the Square of 9, a method that combines price and time in a spiral. Gann's fundamental principle is simple yet profound. Time is more important than price. When time and price are equal, the market must turn. What does this mean? An example. A stock went from $100 to $200. It gained $100. But in how many days? 100 days. This is the equality point. According to Gann, at this point, the market either reverses or gains major momentum. But the real secret was in the planets. Gann used the Jupiter-Saturn cycle. Every 20 years, these two planets conjoin. Every 60 years, they conjoin in the same element group. This is the master cycle. He foresaw the 1929 crash. On September 3rd, 1929, he wrote in his annual forecast report, "The great bull market will end." 6 weeks later, October 24th, 1929, Black Thursday, history proved him right. When Gann died in 1955, his estate was worth only $100,000. Critics point to this as proof. If he could predict so well, why wasn't he rich? The truth is more complex. Gann made most of his money selling courses and books. Most of his own trades were successful but undocumented. More importantly, Gann deliberately wrote his methods cryptically. In his novel, The Tunnel Through the Air, he hid the real system in coded messages. Why? Perhaps he thought the power's secret lies in staying secret. Today, Gann's students still exist, some hedge funds included, but they don't talk much because astrology is taboo on Wall Street. But Goldman Sachs published a research paper in 1999. Topic: the effects of eclipses on markets. Odd, isn't it? Year 2001. Ilya Dichev and Troy Janes from the University of Michigan discovered something incredible. They examined all major stock market indices over the last 100 years: US, Europe, Asia, 48 countries, millions of data points. Result: returns during the 15 days of the new moon period are almost twice as high as those during the 15 days of the full moon period. Concrete numbers: in the S&P 500, average return during new moon periods is 7.5%. During full moon periods, 0.9%. Difference, 6.6%. This isn't just the US, the same pattern everywhere in the world. From Tokyo to London, São Paulo to Sydney. But why? According to Dichev and Janes, my mood misattribution, people are depressed during full moon and avoid taking risks, but they attribute it to economic reasons, not the moon. Critics say, spurious correlation, coincidence. But can the same coincidence occur across 48 countries over 100 years? In 2006, 3 researchers took Dichev and Janes' study one step further. Yuan, Zheng, and Zhu used the sinusoidal model, meaning they assumed the moon's effect isn't a straight line, but wave-like. Result: the market bottoms 1 week after the full moon. Peaks 1 week after the new moon. A perfect Cosin curve. But the truly interesting finding: this effect is stronger in small companies. Why? Because large institutional investors are rational. Small retail investors are emotional. And lunar cycles affect emotions. Look, this isn't just theory. This study was published in the Journal of Empirical Finance. Peer-reviewed, academically accepted research. Yet the mainstream financial world ignores it. Why? Because if it's true, the efficient market hypothesis collapses. If lunar cycles affect markets by 6 to 8%, the market isn't rational. Eugene Fama proposed the efficient market hypothesis in 1970. The idea is simple. All available information is already reflected in prices. No one can consistently beat the market. This theory won the Nobel Prize in 2013. But there's a problem. If lunar cycles truly affect markets, and this information is known by everyone, why does it still work? 2 possibilities. 1. Most investors don't know this information or don't believe it, so information is theoretically available, but not practically used. 2. This isn't a self-fulfilling prophecy, it's a real biological effect, meaning even if people know, it's not under their control. Which explanation is correct? Maybe both. But what's certain? The efficient market hypothesis isn't entirely efficient, because human behavior is predictably irrational. Year 2003. Two economists from the Federal Reserve Bank of Atlanta, Krivelyova and Cesare Robotti, decided to research something unusual: the effect of solar storms on markets. Geomagnetic storms. Plasma bursts from the sun's surface disrupt Earth's magnetic field. GPS systems crash. Satellite communications cut out. Power grids are threatened. But what's the effect on markets? They examined S&P 500 data from 1927 to 2000. Average return on geomagnetic storm days: minus 0.06%. On normal days, plus 0.05%. The difference seems small, but is statistically highly significant. On high geomagnetic activity days, markets deliver 15.13% lower returns. How does this happen? Melatonin. During solar storms, melatonin production in the human body is disrupted. Melatonin affects sleep cycles, mood, decision-making ability. So traders unknowingly make worse decisions because of the sun. In the 19th century, Russian scientist Alexander Chizhevsky noticed something. There's a correlation between sunspot cycles and crisis periods on Earth. Wars, revolutions, economic crashes, all intensified during periods of high solar activity. Chizhevsky named this helibiology. The idea: the sun doesn't just provide light and heat, it sends electromagnetic radiation, cosmic rays, particle streams, and these affect biological systems. Modern research confirms this. For example, heart attack rates increase 13% on geomagnetic storm days. Suicide rates rise 32% during full moon periods. Traffic accidents are more frequent when solar activity is high. Even Wikipedia edit wars peak during full moon. All peer-reviewed studies. But mainstream science sees these as interesting correlations, not causal relationships. But on Wall Street, if solar storms disrupt investor psychology, this isn't a rational market. This is a biologically manipulated system. Every living organism has an internal clock, circadian rhythm, a 24-hour cycle. But actually in humans, this cycle is 24.2 hours, meaning slightly longer. How do we synchronize? With sunlight. Now think about this. The New York Stock Exchange opens at 9:30 a.m. Traders wake up at 6 a.m., drink coffee, look at screens. Cortisol levels in their bodies are high. They're awake but not yet fully balanced. Research shows trades made early in the morning are more volatile. Markets are more stable between 2 to 3 p.m. Why? Circadian rhythm. A 2019 study proved this. Traders' decisions vary by time of day. More aggressive in the morning, more conservative in the evening. But lunar cycles? The moon doesn't just affect tides. The human body is 60% water, and this water is also affected by the moon's gravitational pull. Hasn't it been scientifically proven? No. But there's not enough reason to ignore it either. James Simons, mathematics professor, founded Renaissance Technologies in 1982. Medallion Fund, the most successful hedge fund in financial history. 66% average annual return for 30 years. Even after fees, 39%. How? Nobody knows, because it's completely secret. But there are a few clues. Renaissance only hires physicists, mathematicians, and computer scientists. No MBAs, no economists. Why? Because they view the market not economically, but as a physical system. Chaos theory, fractal geometry, pattern recognition. In 2015, a former employee said, "We used lunar cycle variables, but I can't say in what combination." Renaissance's algorithms make thousands of trades per month. No human intervention, just data and mathematics. But are planetary positions among this data? Officially, no. But according to former employees' statements, astronomical cycles are definitely being tested. Because if a pattern works more than 51%, it means arbitrage opportunity. Something strange happened after 2020. The financial astrology hashtag went viral on TikTok. Millions of views. Gen Z investors view markets differently. While trading on Robinhood, they're also pulling tarot cards, making market predictions with astrology apps. Boomers find this ridiculous. But does it work? A 2021 study was conducted. Gen Z investors using astrological trading strategies outperformed the buy and hold strategy by 8% on average. Why? Two theories. One, astrology is actually a risk management tool. Don't trade during Mercury retrograde means be careful during volatile periods, not random, pattern recognition. Two, self-fulfilling prophecy. If enough people use the same strategy, it actually works, because markets consist of human behavior. Modern finance calls this behavioral herding. Astrology has been doing this for 3,000 years. What's interesting? Goldman Sachs, JP Morgan, Credit Suisse, all use alternative data, satellite images, social media sentiment analysis, weather data. So why not planetary positions? In January 2021, GameStop short squeeze. Reddit's Wall Street Bets community declared war against hedge funds. But nobody noticed this. During that period, Uranus and Saturn were in square position. In astrology, this means revolution, anti-establishment, unexpected change. Coincidence? Maybe. But during the 2008 crisis, there was the same Saturn-Uranus cycle. In 1929 too, in 1987 too. This cycle occurs approximately every 45 years. And each time there's major turbulence in the financial system. What if someone used this information? If you knew the Saturn-Uranus opposition was coming in 2020 and predicted there will be a movement against the system, you'd invest in GameStop and get a 1000% return. This isn't astrology, this is cycle analysis. But astrologers have been doing this for 2,000 years. Now ask yourself, what from this video do you believe? The fact that lunar cycles affect markets by 6 to 8% is proven in 48 countries with 100 years of data. The Federal Reserve has published research on this. Solar storms disrupting trader psychology has been demonstrated. But you still say astrology is nonsense. Why? Because the word astrology is loaded. It evokes mysticism, superstition. But if I present the same data as lunar cycle effect, you find it scientific. If I say geomagnetic storm correlation, it's accepted. When the name changes, acceptance changes. The truth is, the universe consists of cycles, seasons, tides, solar cycles, orbital mechanics, all predictable, mathematical, physical. The human body is also a biological system, and these systems synchronize with cosmic rhythms. What about finance? Finance also consists of human behavior, so indirectly connected to cosmic rhythms. Is this astrology? No. This is systems theory. Carl Sagan once said, "The atoms that make up stardust formed the eyes that study stars." Maybe the problem is this: humans see themselves as separate from the universe, but we're not. We're part of the universe. Without the sun's gravitational pull, Earth's orbit would be disrupted. Without the moon's gravitational pull, ocean currents would stop. Life would end. So why do we assume there are no invisible effects? We can't see electromagnetic fields, but cell phones work. We can't see radio waves, but we hear music. Maybe the effect of planetary cycles on human psychology is like this: invisible but measurable. Who are Wall Street's prophets? Algorithms? Partly. Because algorithms are human designed. Planets? Partly. Because planets affect human behavior. The real answer? Both. Because everything is connected. And maybe the real question is, do we truly make decisions with free will, or are we swimming within the universe's cycles? Let's ask this not to believe, but to understand. When will the next big market crash happen? Astrologers look at the Saturn-Pluto cycle, 2026 to 2027, historically major crisis every time. Quant funds look at their algorithms. Machine learning models search for patterns. What are you looking at? This video was prepared not to answer but to ask questions, not to believe but to understand. If this research journey interests you, don't forget to subscribe to my channel, because in the next video, we'll dive into even deeper waters. Data astroarchaeology, in pursuit of lost knowledge,